Today we're going to talk about one of the fundamental concepts in commercial real estate, a capitalization rate or cap rate. This concept, although very core to the business, is often misunderstood even by those within the industry. So today we're going to dig into what is a cap rate, when is it useful, and when is it not.
Mathematically, the capitalization rate or cap rate is the net operating income divided by the value. You can also interpret this as the cap rate is a lie, NOI, divided by a fantasy, seller's asking price. For easy math, if a property was listed for $750,000 and generates $75,000 per year in net operating income, then the cap rate would be 10%. So what does this really mean? First, the cap rate and value are inversely related. As the cap rate goes up, the price or value of a property goes down. One way to think about cap rate is that it represents the percentage return or dividend that an investor would receive on an all-cash purchase. One important item to point out is that just like any investment, typically the higher the return or cap rate, the higher the risk involved. Remember NOI? The cap rate does not factor in any type of financing or mortgage payments. On a cash flow worksheet, the net operating income line is above the debt service or mortgage and interest portion in your cash flows. A cap rate can be a very useful tool when valuing commercial real estate in several scenarios. It allows you to quickly compare acquisitions relative to other potential investment properties. So if you were considering a property with a 6 cap and another with a 14 cap, you should recognize immediately that one of these properties has a higher risk premium associated with that. Now that might be a good thing, or it may not, depending on the rest of the circumstances. In my opinion, cap rates should be based on a closed sales price, not just on what the property was listed for. I know in my valuations I'm always looking at both the list cap and the sales cap rate for comparison. By looking at trends of submarkets with closed sales over the past few years, you can see based on cap rates where a market is headed. For example, if cap rates are compressing, that means values are being bid up and the market is heating up, and vice versa. Then you can research further to determine why and if you think that trend is sustainable. Despite the ease of using cap rates, there are a few drawbacks. Remember the formula for a cap rate, NOI divided by value? Well, that net operating income is based on a single year's performance, not the whole picture. If a property is stabilized and performing well, cap rates can be a great tool to compare values on the surface. But remember, it's only for a single year. What happens if the property has varying cash flows or will require substantial rehabilitation or releasing? Anytime you are dealing with a property that has irregular cash flows or a complex income stream, the only way to yield a credible and reliable valuation is from the internal rate of return, or IRR, with a full discounted cash flow analysis. You can also build in your own required returns with the cap rate through the band of investment method. Commercial real estate is a multi-layer process. While it can begin with simple tools such as cap rate, it'll quickly evolve into a complex cash flow analysis, before and after tax scenarios, and other economic influences and indicators.
So I hope you've learned something from this video. If you need help building an accurate projection or you just want someone to take a second look at the numbers, give me a call or shoot me an email. And if you think anyone would enjoy this video or may learn something from it, please forward and share below. Thank you so much. Have a great day.